So you're a new investor and you're trying to get deals going and you hear this term called hard money. Well, what is it? How do you even use hard money? And in this video, I want to be explaining that to you, how to leverage hard money so that you can grow a real estate portfolio and build wealth. You're watching TMBRMAN TV. All right, so you clicked on this video because you saw the title about hard money, which means you're curious on how hard money even works. You've heard this term, you want to start investing in real estate. So we need to break this down on the benefits of hard money, how it works, how to leverage it so that you can build a portfolio. All right, another aspect of hard money is typically their short terms, 6 to 12 months. I think the most common one is a 12-month term, so 1 year. This is a short loan, but the reason for that is it's gonna be an interest-only payment. So you're not paying principal, interest, tax, and insurance, you're just paying interest. And basically that year is giving you a timeline to complete your project. Now you can extend or you can bridge out of that if need be, if it's a larger project. However, most fix and flip on a single family residence, on a duplex, is gonna take at least less than 12 months once you start construction. So that's typically what the terms are. You have a 12-month term, interest-only payments, and then you have a rehab budget which will be paid to you in the form of draws. So let me give you an example. When I did my very first flip, I came to title with a down payment, we signed, we got closing, we funded, so now I own this property that is worth X amount of dollars that I need to put X amount in to bring up the ARV with my hard money loan. So once I started to rehab the property, I would have to call in and check in with the hard money people, the lenders, to say, hey, I need a draw because I've done this to the property. They'll send someone out to verify, take pictures, and then direct deposit into my account the dollar amount associated with that portion of the project. So there's a trust aspect in there. They don't just give you, let's say, $50,000 of rehab up front in your bank account, because hey, what if you go to Vegas and spend it all on gambling or do something stupid with it, right? So they're gonna be step by step with you as you do your rehab. Once you spend, let's say, $5,000 on flooring, well, they'll match that and direct deposit $5,000 into your account. Then you do the painting, then you do the kitchen, all that will be direct deposited as you progress through your project. That's keeping everyone honest and on the same page. So that's again how the terms work. You have to go to title, you're gonna close, and then once you do your rehab, you're gonna be in communication with your lender the whole process up until you're ready to sell it. And then that's when your hard money lender gets paid off, is once you sell. So again, hard money is not a scary thing. You just have to know how to utilize it so you don't get caught. Well, you're gonna say, well, Nate, what if I'm not done with my project at the end of the hard money loan, at the end of that 12 months? Because at the end of the 12 months, that note is due. Well, you can get another hard money loan. You can bridge to pay off that first hard money lender. So again, don't be scared to use it. This is what everyone uses in investing to grow their portfolio. It's essentially utilizing other investors' funds to fund your investment. The reality is, in traditional lending, you're really tied down to one loan, and then if you get into investment properties, it costs a lot more. That's where hard money comes into play, with quick closes, with less terms and less regulation, and it allows you to grow your portfolio, to flip deals, to wholesale, to do a bunch of things that you wouldn't normally be able to do with traditional lending. In layman's term, hard money is basically people selling investors money that's not regulated by the Fed. So to understand this, we need to understand what is regulated by the Feds, which would be traditional conventional lending, which is owned by Fannie Mae and Freddie Mac. So that's typically what 99% of Americans have on their house, is a Fannie Mae, Freddie Mac mortgage that's backed by the Feds. Now, hard money is not backed by the Feds. This is investors' money that they're lending out on their own terms. So there's really no regulation on hard money versus your conventional lending. There's a ton of regulation, and people can get in trouble with conventional lending if it's not done with a license and under strict guidelines set by the Feds. So there's a huge difference between conventional, traditional lending and hard money lending. So let's dive into, well, when would I use conventional and when would I use hard money and why? In a conventional mortgage, typically this is people buying a primary residence, whether they go through an FHA program, a VA program, USDA, or just a regular conventional loan. This is a primary residence for the most part. You can buy investment properties through conventional lending, but it's just much more burdensome, I would say, than using the hard money side, and I'll explain that. So on the traditional side, primary residents, first-time home buyers, people that are using it as the house where they live, you're always going to see them use conventional lending. And the reason why is because you can get the lowest rate at a 30-year fixed note. So this is a home that they're going to stay in for a long time. You want that low interest rate and you want a 30-year note. On the contrary, a hard money lending is going to be a short-term financing, and it's going to be 100% investment properties only. So there's a lot less restriction on what you can buy on the hard money side versus the conventional side, and the terms that they offer you in order to do that. The reason investors use hard money is because they don't typically look at your debt to income ratio. When you're over here on the conventional side, if you already have a mortgage and you try to buy another property, well, they're looking at your debt to income ratio saying, well, you already have so much going out based on what you're making that you can't afford to buy another property. However, on the hard money side, they don't take that into consideration. They're looking at the deal as a whole. And people that use hard money are typically doing a fix and flip, meaning they're buying a distressed property for a discounted price that they're going to put money into it to bring it up to a higher value. They're rehabbing it. They're bringing value to the property. And in a commercial side, this is called value add. So people do this with commercial buildings, tenant improvement. You can take any piece of real estate, put money into it, and bring the value up. They would call this a value add fix and flip loan. There's also another type of investing where people want to fix up the property, but they want to hold it. They don't want to sell it at the end. Remember, a fix and flip, they're going to fix it up, they're going to sell it and make a profit. Now on the buy and hold side, they're going to fix it up, they're going to value add, they're going to bring the value up because of the improvements they've made to the property, and then they're going to take that new property, go back over to conventional financing and get what's called a cash out refinance on it, which means they have a 30-year note now at a low interest rate on a property they use hard money on to bring the value up, and they use that quick, less strict financing to get it done so that over here on the conventional side, they'll finance that property. The bad part that kind of sucks about the hard money side is that you're not going to have good rates. Typically, rates on hard money are going to be from 9 to 12%, could be lower, could be higher. It just depends on your experience, the loan amount, what type of project that you're doing. But I'll say this, if you're just starting out in real estate investing and you're starting to flip properties or do buy and holds, you're gonna see higher interest rates, you're gonna see more points, and a point is just a percent of the total loan amount. So if you have a $100,000 loan, 1 point is gonna cost you $1,000. So when you're shopping for hard money, you can shop points, you can shop interest rate, but it really doesn't matter if you're brand new in the game. You're gonna get stuck with the highest percentage and typically at least 2 to 3 points on your hard money loan. But that doesn't matter. You have to look at the numbers. You have to look at the deal and say, hey, without doing this, I'm not even going to have any profit. So suck it up. That's how I got started. I think in the beginning I was paying 12%. I had like 3 or 4 points on my loan. But guess what? I got a deal done. It was my first flip. I actually made some money on it. I had a JV investor partner on it. And guess what? That helped build my credibility with hard money lenders. The more experience you have, the hard money lenders are going to slowly bring that rate down and those points down so that you can have better terms as you build your portfolio. Another benefit of hard money is they don't care about your primary residence. Again, if you own a primary residence, that's great. They're strictly looking at your experience. They will check your credit just to make sure you're not someone that's totally irresponsible, but they're really more interested in the deal. So you're going to show them what your purchase price is, how much rehab you're going to put into the property in a dollar amount, and then what the ARV is, the after repair value. So again, the biggest thing is purchase price, rehab, after repair value, or ARV. This is what hard money lenders care about. If these numbers make sense, they're going to give you terms to accept this deal and fund on this deal. If these numbers don't make sense and you have a high purchase price and a low ARV that doesn't have enough spread for profit, well, probably not going to lend on that deal. So those are the benefits of using hard money is, hey, they're more interested about the deal. Conventional lending, it's all about your financial profile, and once you max that out, unfortunately, you can't really borrow anymore. On the hard money side, it's untapped, it's unlimited. And the beautiful part about that is you can do what's called joint ventures, or JV. So a joint venture is bringing in another partner that's going to join you on these deals. They bring in their credit, maybe they bring in the down payment, and you can split the profits. And this is a way that I still utilize today in my investments to grow wealth, to grow properties. In fact, if you've made it this far in the video right now, that's something I'd recommend 100% to do, is start out your investing career by utilizing JVs with someone that's experienced, someone that's done projects, someone who's dealt with hard money lenders before and already has a reputation with these hard money lenders, therefore getting lower interest rates, lower points, but they're going to give you the knowledge that you need, the experience you need to gain so that you can go do this on your own. I currently am JVing with people on their first deals. I'm super excited about it as someone that's done several projects, and I will continue to do this. I love partnering up with people. If you're watching this and you have a deal, send me an email, drop a comment below and let me know about it. We can definitely chat about what the deal looks like. However, that's something I would definitely recommend. Start with a JV, have someone come in alongside you so that they can mentor you, take you through the process from start to finish on your very first flip, on your very first BRRRR, on your very first buy and hold. It's something that's going to pay off in the long run. All right, cool, Nate. You've talked about hard money, but where do I find these people? Well, my advice to you is the easiest place is online. You can do a Google search, or what I like to do is just get on Facebook, go to investor groups, say that you're looking for hard money lenders, and you'll be surprised at how many people will drop in your comments saying to message me or that they're a lender. So start there. Just go online, Google it, go to Facebook, go to different groups, start telling people that you're looking for hard money. They will definitely pop up. It's not hard to find them. But do your research, shop around, compare terms, get to understand what the terms look like, what they mean, so that you can make the best decision for your investment. All right, so in closing, I hope that you understand what hard money is. Remember, there's conventional lending for primary use, for your personal residence, and the hard money side is investors' money that they're selling that's not regulated by the Fed, so that people like you and me can go do as many deals as we want to do. Typically, they're 6 to 12 month terms, they're interest-only payments, and they are due at the end of that 12-month term. I hope this video has been helpful. Let me know if you've learned something. Leave a comment below. Make sure to smash that like button. You're watching TMBRMAN TV. We'll see you next time.